The Treasury market is flashing a possible warning signal. We're referring to a bear steepener. This is not always a negative event, but the timing is what's cause for concern. We're going to show you what a bear steepener is, what we would hope the Treasury market should look like right now, and what it's actually telling us. Here are the Treasury bonds, the yields as of October 1st on the left-hand side, 3-month, all the way to the longest term maturity, 30-year on the right-hand side. And notice, as of October 1st, we had the highest yields on the short-term side of the scale, moving down to the 5-year, only rising near the 10, 30-year maturities. Notice how this has changed from October 1st to present date. The yields have risen dramatically on the longer term side of the Treasury markets. This is what's known as a bear steepener. It's a market phenomenon where long-term yields rise faster than short-term. It's usually indicative of rising inflationary expectations and prices. Now, it's called a bear steepener because, again, the yields on the longer term side are going up, but when yields go up, the bond price is actually going down. So we're looking at a bear market in 10-year bonds. Investors sell long-term maturities more than short-term, anticipating higher rates. See, the bond market is saying, hey, look, the Federal Reserve's cutting rates, stocks are near all-time highs, the economic numbers, they look pretty good. So the Federal Reserve, we're probably running into more inflation in the future. They're cutting rates. We're not going to buy the bonds now. We're going to get higher yields. Let's sell the bonds. And that's why the longer-term yields are rising. Oftentimes, this is the result of the Fed raising rates too slowly to combat inflation. But wait a second, the Fed's not raising rates. They're in the process of cutting rates. See, here's the timing problem. A bear steepener usually occurs when the Fed is, getting close to raising rates. We're in the process of cutting rates. Now, take a look at the following. This is the 10-year, present date, by the way, 10-year moving up more than the 1 year as, again, the Fed cuts rates. The orange line here, that's federal fund interest rates, cutting rates in September. The white line is the 10-year bond minus the 1 year. So when this is trending higher, it's showing us not only that the 10-year bond yield is rallying, it shows us it's rallying that much more than the 1 year. Now, under normal conditions, the 10-year moves up more than the 1 year as the Fed prepares to raise rates. This goes back to 2016. And the Federal Reserve, we had very low interest rates. We saw a lot of growth, a lot of inflation. The Fed started to, be on the track to raise rates, and the bond market reacted accordingly. And the 10-year rose more than the 1 year. Kind of looks like where we are now. But at the time, there was a threat of inflation. Now, this is what we want to see right now. The 10-year falls more than the 1 year as the Fed's cutting rates. The orange line again, interest rates. White line, 10-year bond, minus 1 year. And it's moving down. Now, of course, we don't want the market to move down too fast, too quickly, too much too quickly, because that would be indicative maybe of a recession. Ideally, we want a soft landing. We want a little bit of a decline in the 10 minus 1 year maturities. But that, again, is not what we're seeing now. The bond market is forecasting a resurgence of inflation. Should the Fed continue to cut rates? We pose this question to you. Let us know in the comments. The Fed's cut rates again, and we're running into the threat of inflation. That's what the bond market's telling us. And again, as interest rates continue to decline, the bond market is saying, hey, we're not going to buy the long-term bonds now. We're most likely going to see higher rates, in other words, inflation in the future, sell long-term maturities. Speaking of inflation, we published this very recently on our Just the Data Substack newsletter. It's a study of inflation, the many different facets of inflation that we're combating right now. And there's ways that we can put ourselves on the right side of inflation, such as certain areas of the stock market, and also fall victim, such as what the manufacturers are fighting right now. And we dive into all of this, and we'll provide a link for you in the comments of the description of this video, as well as a link to the video itself. We hope this has been helpful. We look forward to seeing you back soon.